It's always important from my perspective to just take the other side and intellectually debate with oneself why the other side could be right. So at this point right now, what people would say is, okay, the Fed's going to capitulate at the beginning part of 2023. We have a pretty clear forecast for all the rate increases that have to happen. Everybody's doing the work that's necessary, either raising prices, cutting costs, or doing both, letting people go, et cetera, et cetera. So maybe we're there. But what's the other side of that? I think, again, as I've stated before, the other side starts with energy. And the reason why I think it's important is that it really is the conflation of an economic system and a political system using an instrument. And if you look inside of what's happening in Europe, there's a lot of complexities here that I think need to get unpacked. So, for example, a couple of days ago, the French government basically said that they're going to start producing less nuclear energy. And you'd say, well, why would they do that? Well, it turns out because the temperatures are so high, you cannot use the water to cool these nuclear reactors because the exiting water is then so hot that it would actually destroy the ecosystem of the lakes and rivers that they use to feed natural fresh water in to cool the nuclear reactor. Second, because it's so hot, all the rivers are below their natural level. Barges that carry coal and nat gas are getting stuck on the Danube. The Po, which is the longest river in Italy that feeds all the fields, is below the level where it can actually offload the water. So farmers can't basically do what they need to do to produce a food supply. So if you play all of that out, you start to see an issue where we're back into the same complexity where energy is the tip of the spear around which everybody starts to debate all of the national security issues that we have to deal with, the Ukraine war, et cetera, et cetera. You've made a lot of money this year by basically doing the following, which is the exact opposite of everybody else. When everybody else was freaking out, had you bought, you would have made a ton of money. Now everybody's like, it's over. And you can tell that by looking at the VIX, which is the volatility index. We're about to get into the high teens. You have systematically, it has been true that the VIX is in the teens. You tend to basically buy volatility, which is essentially you get short stocks. And when the VIX is in the 30s, you tend to basically sell volatility and you buy equities because we've hit the bottom. If you've been doing that for the last year, you've made a ton of money. So I tend to think things still have to get a lot worse to flush everything through the system. We've never seen a moment in history, in American history, where when CPI has printed successively above 5%, that it got under 5% without Fed funds getting to that same number. So we should all hope that this is the exception that proves the rule, but there's an enormous amount of data that would tell you that we have to take rates to double what the equilibrium rate is thought to be right now. There's always stuff going on in markets, and markets represent the collective sum of our wishes and expectations and also the realities. This is why I think, for me at least, the way that I process this information is not trying to have an opinion on any one of those things, because for me, I'd rather go back to the historical trends because those I find a little bit easier to parse. And the real problem is that, if I go back to the historical artifacts, have there been issues in the past? Absolutely. So this is why I think you can look at the fact that whenever there's inflation and whenever it's spiked, what has had to happen by the Fed is you have to take rates above that key 5% threshold when CPI is above 5% to break enough demand so that the economy's reset. I think that's where we are. So instead of trying to figure out, I'd rather just say there are 20 or 30 things that could very much complicate the world economy. I think the reality is that governments need to flush all this excess money out of the system so that we can really find out what equilibrium demand is and get back to normal. That era of cheaper, faster, better is over. And what comes with that is better national security, but the cost of that better national security is higher prices. And there's nothing that we can do to avoid that. I'm not sure I agree with the less growth. I actually think that there's enough excess slack to be absorbed by all of this free money that I think you can still have sustained growth, but it will come with higher interest rates and higher inflation and higher input costs. Everybody will have to do their part to absorb some of this, but that's what's going to happen. And I think we should just deal with the medicine as quickly as possible. This is why the people that actually think that the Fed should just be very aggressive and get this over with quickly, I suspect on the margins are right. The problem is they don't want to look at the historical artifact, because the historical artifact would say, wait, I need to raise interest rates by another 250 basis points. That's just way too disruptive for what the world is ready to hear right now. So we're going to incrementally plod along. There's going to be a whack-a-mole that emerges. That's going to tilt the markets. Then the consumer credit thing will implode. That's going to tilt the markets. Then Jair Bolsonaro will try to take over Brazil. That'll tilt the markets. And we'll go back to this, inflationary, fragmented, deglobalized view of the world that just frankly takes higher interest rates to normalize. The thing that we really have going on is that over the last 8 quarters, we've had all kinds of very turbulent data that's made the trend line unpredictable. And the most obvious way to see this is actually in one specific subsector, which we'll get to in a second. You see this one huge spike coming out of nowhere. And then eventually everything has settled back to trend. The same way, I think what we're waiting to figure out is how many quarters does it take for us to get back to on-trend growth in the economy. We had a massive shortfall in Q2 of 2020. We had a massive surplus in Q3 of 2020. We've had a country that's been getting back to finding equilibrium over the last 5 quarters. So we don't really know what the steady state growth should be. This is why I specifically had such an issue with the tone the White House took, which was trying to explain away that this isn't a recession by trying to create doubt in the definition. Instead, I think it would have been much better off just repeating what I just said and explaining basic statistics and actually showing that the country is headed in the right direction, largely speaking from a really crazy one-time externality that nobody could have predicted, that it's going to take some number of quarters. And so really what you should look at is employment and wages and try to be a little bit more circumspect in overreacting to any one quarter data. By the way, the Fed exactly just said the same thing when they raised 75 basis points. They said, we are not going to give guidance anymore because things are too turbulent. We're going to remain vigilant on inflation, but mostly we're going to be very near-term data dependent. So I would boil all of this in saying, let's not overreact to a quarter's print here or there, and specifically the label. I think the White House made a mistake in trying to basically think, we all didn't understand what a technical recession was. I think instead we should just focus on what we have to do to get back to solid state equilibrium. The point is, excess money, because of loose financial conditions, distort what true supply and demand should be. And excess money can come from the government. But in this case, excess money went from the government into the hands of individuals who then participated in the public markets, and they distorted what it all looked like. And so there was a lot of purchasing activity that was propped up by what seemed like an endless supply of free money. And so now that that money is getting taken out, we don't yet know what the real equilibrium economic growth rate should be, because you have to remember, we have not seen an era without federally introduced spending, without federally introduced forms of quantitative easing since the great financial crisis. So we have been propping up our economy for 14 years straight now. So we have distorted the prices of bonds and fixed income. We've distorted the prices of equities. We've created an asset bubble in crypto out of nowhere. And now we have to do the hard work of figuring out what the real supply demand is in the economy. And we don't know. Shell and Exxon and these guys are printing enormous record profits. Putin cut Nord Stream by another 50%. It was already running at 40% capacity. He cut it down to 20%. It's only getting worse, making the problem even worse. So because Howell was catering to whatever pressure he's been getting, and he must be getting some severe pressure from the White House, those were really dovish comments. But what is the problem when he is dovish? Well, the practical reality is a couple of things. Number one is typically the yields of long-dated bonds go down. That essentially tells everybody else to reprice assets. What does that practically do? It makes the cost of borrowing roughly cheaper. It makes the price of equities, particularly ones that are far out on the risk spectrum. So specifically, let's focus on NASDAQ and crypto, right? Tech stocks, biotech stock, and crypto stocks go up much more aggressively. So what has Powell effectively done? He has synthetically created a form of easing. Again, like his job at the Federal Reserve, if you think about the money supply as a pipe, it's to shrink the pipe to close off demand to get things in equilibrium. So even though he's doing this, by the language that he's doing, he's effectively allowing market participants to basically guess that the worst is over and now we're going to start to expand the pipe again. And so they go to the end state. So what he effectively did in one speech is basically put a pin at the end of this year and is telling the markets, I'm mostly going to be done. And if anything, I'm probably going to be cutting in the back half of 23. Go on your merry way. It's now pushing the problem out another 8 quarters. Like, we need to stop this nonsense. He needs to be definitive, and he needs to fundamentally break the back of inflation so that you find out what the true demand is in the economy. We've never in the history of America ever had CPI print above 4.5% or 5% without inflation being brought down by having Fed funds not also be greater than 4.5% or 5%. So at some point, inflation will turn over and we'll print 6 and 7%, but that's still not below 4.5% or 5%. So we could still be only 50% of the way there if inflation remains at 4 to 5%. And this is what I think market participants don't want to hear. They don't want to hear that there has to be a meaningful form of tightening. And politicians don't want to hear that. The White House for sure doesn't want to hear it. The problem is that if Powell caters to too much of that feedback, he's not going to do what he's supposed to do and why he's put in that job.